Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Welcome to another episode of Carolina Commercial Real Estate Connection. Today we have Sridhar with us. Sridhar is out of Dallas, Texas. He does multifamily syndication. Sridhar, thanks so much for joining us.
Thank you for inviting me to the podcast. Yeah.
Yes, sir. All right, could you take a moment and tell us a little bit about yourself, a little bit of background?
Sure. Hi, good morning and good afternoon, what time it is going to be launched based on it's good morning mostly, I assume. I'm Sridhar Sannidhi. I'm out of Dallas, Texas. I've been an IT professional for 30 plus years, and recently I switched my career into commercial real estate full time. But I've been doing the commercial real estate for more than 5 years prior to that. I worked in Wall Street for like 18 plus years, and then technology space, mostly in technology space, and then continued that even after relocating to Dallas. So I've been thinking of starting some ITV venture, but unfortunately, a couple of my efforts I had to abandon due to partners not coming forward afterwards. So then I thought that I should do something that I have full control on or I can do by myself. And I started working on single family portfolio, but to my surprise, after trying for almost a year plus, I couldn't buy any single families. And my effort went south. And then I thought I should go big and bold. That's when I started this multifamily in 2018. So first I invested in passively in a couple of deals. And then after that, I felt comfortable, started active deals while doing full-time W-2 job. I was able to syndicate in a lot of deals. In total, I was a GP in 3,800 deals. At the moment, we only have like 3,800 doors as a GP. At the moment, I only have 2,700 plus doors as a GP. We did full cycle and almost 1,000 doors. I'm also doing ground-up development of multifamily and other commercial real estate. At the moment, I branched out to development space a couple of years back. We are building a couple of big multifamily complexes in Dallas area. Yep.
That's a lot. That's a lot to take in. That's awesome. I hope I took enough notes to keep up. Oh my goodness. All right. Well, that's great. Well, let's kind of back up a little bit and get a little deeper. Some of the stuff you said. So when you started, you left Wall Street and went to Dallas. Your first idea of what you were going to do was an IT company, because that's where you were coming from. And if I understood what you're saying, so you came down, you started with a couple partners, and they weren't helpful at all, and kind of left everything on you, right?
Yep. That is correct.
So you worked your way out of that and decided you were going to do single family, and in the single family you just couldn't buy anything for a year and a half. You were looking, by saying you couldn't buy anything, was that meaning everything was overpriced, or you didn't nothing was attractive enough as far as a good enough return?
That is correct.
Okay, perfect. All right. And then you started investing passively. So I think that's a great way for somebody to get into the business. So if you could do on that, let's walk through that a quick moment and say, what advantages did that give you? So when you joined and invested passively, could you tell us some of the things that you learned from those investments?
Sure. So once I decided to come into the commercial real estate, first I explored what segment within commercial real estate I should invest in. The first option was hotels, motels. That's what I was looking for, and because a lot of people told me that, oh, those are better and all that. But I started attending a bunch of real estate events, conferences, and then I bumped into multifamily event. And I felt it's very convincing, and I felt that some part of it is true, like not 100% at that time when I listened for the first time, because there would be a marketing pitch always, right? So I thought that I should take it with a grain of salt and then say that, okay, I can believe half of it at least. Let me try investing in a couple of deals and see how the progress it would be. And then I was not sure about the ownership of investment money, how secure it would be. And then whatever they're promising, is it really going to transpire or not? That all that was not sure. So that's why I wanted to take a risk. Initially I thought of investing only in one deal, but then I thought that let me take two. And then in two deals I invested in, and then first thing I saw is after first quarter I got the check. I said, oh, this is something that looks good. And I didn't do much except on the initial research on whether the deal is good or not. I did preliminary research, like looking at the location and then looking at crime rate I checked, income levels I checked, and jobs and companies that are around surrounding that area. That's what I checked. I said, oh, looks like this is a stable area. Let me invest in. And I did not research too much on general partners.
Yeah, I was going to say, so it sounds like you did your very good due diligence on the property itself. Right.
Yeah.
From what you're telling me. So when you're saying you invested in two, were both of them with the same group, or were they
different groups? But different.
Okay, so
groups.
two different groups.
First one, yeah, different groups. But very first one, it came from like a bigger pocket connection. So I thought, okay, maybe they've been there and they've been posting the deals there. So they've been interacting with people, not posting the deals there. So I thought that if they're not genuine, they won't be there posting for years there. So that was my take.
That's a good way of looking at it.
Yeah. So that is
in other words, on bigger pockets, you're there, and you saw that they had a year of history of posting for connections and no negative reactions, basically within bigger pockets, which made you feel a little comfortable dealing with them off the bat.
Yes,
so that was awesome.
That was the due diligence I did on general partners, nothing more than that. Yeah.
Right. All right. So perfect. So you got them. So you sounds like you did a good initial vetting, then vetted the actual deals, which is good. So you were getting the understanding of basic underwriting the deal by the location and the demographics of the area. So you got a better understanding of that, and then the deals turned out well from what it sounds like.
Yes.
And how had those deals gone full cycle at this point?
Yes, both have been full cycle, and I got the money with whatever projected return was, and timing was good. That was a very good market in like a 2017-18 timeframe. Yeah.
Oh yeah. Yeah. Well, that's awesome. So once you then did those two, then could you kind of walk us through the next steps? So did you do any more passive investing beyond those two, or did you go straight into becoming a general partner at that point and have the comfort to move?
No, that gave me the confidence that we can do also, because what they were giving me was like a monthly newsletter and what they have done and blah, blah, blah. So I thought that, oh, that looks manageable while doing the full-time job. All I need to look for is a partner who can handhold me in the first deal as going for active deal, so that if I cannot go and check out the property, and the other person can go and all that. So that was the thought process. And in the first, in one of the events, I found one partner, and also I have a close friend. So three of us started syndicating in our first deal. We found the deal, and then. So
you found the one one of the gentlemen that you're partnered with, you found through networking and going to network events, which is so important in this industry. And you, it sounds like through also going and through this networking, you were able to settle on the one asset class and kind of dive through all that. So the networking and going to these conferences is so important because you're seeing all these people that are actively investing. You can find the right people. And I think it's important to find out, what your skill is, what you bring and what you lack, so you can then fill what you lack with a great partner. So identifying all those things is critical. So could you tell me a bit about your partners, what you bring and what they brought to help you in order to make this a great cohesive team?
Yeah, that partner was doing like multifamilies, but smaller size. Like he was buying 25 unit, 30 unit type of size. Another friend of mine and me, we told him that let's go big. So that is where, from my understanding from all these events, it makes sense to go a little bigger so that we get economies of scale and then we can manage it. It should not be too big again to manage because it's the first one. So let us go with like 100 units type.
You went with you started looking at 100 units with the three of you. And so with the three of you, could you kind of break down who brings what? And so you bring, what is your strength that you brought to the team?
So the other gentleman whom we met at the networking, he has been doing the deal. So he has connections with all the brokers. So he is getting deal flow. Myself and my friend, we were basically said, okay, we would be able to raise the funds and then manage any back office while doing the full-time job. That was our way of contributing to the deal. So that's how it transpired. So the partner brought the deal, and then we raised the funds, and then after that we are kind of managing the back office activities and.
That's a perfect setup. So that's a great way whenever you're looking for partnerships in this commercial space. To me, it always makes sense 3 to 4 people in these partnerships, because you need someone that specializes, just like what you said. Somebody needs to specialize in being able to obtain the capital. Right. So having the connection with the larger private equity firms, being able to have individual investors that you can call on for money, then you have to have someone within your team that's great at finding and acquiring deals, that's out networking, almost doing business development all around networking, finding deals, finding locations on where you should buy, then acquiring deals. Then you need someone managing the back office, doing underwriting, looking at everything, making sure it pencils, then being able to put out monthly reports, quarterly reports, and getting everybody that their payments out. So, and collecting rents, all of that. So there's a lot of back office involved, but to continually get deal flow and continually be able to execute on deals, you have to have all those pieces in place. Way too much for one person to manage successfully, typically. But when you get a great team like that, that's where you can really start to scale and grow. So it sounds like you did very well putting your team together and then starting. So let's kind of walk through, how did your first deal come about and how have you guys gone on? And then we'll get into the development aspect, but this has been great so far. So tell us a little bit more. So now you're together, you start looking at 100 units. What did you find and where did you go?
So we found it in Wichita Falls. It's a little bit of heavy lift, 40 plus units were down. And basically the current owner gutted it down to upgrade it completely. So without knowing much, we thought value add means it should be like that, and then heavy lift. So we took
that sounds like a big lift. So let's, on a high level, can we walk through kind of the numbers on something like this, what it looked like? So do you remember that? Like how many units?
Yes, we bought it for $3 million. Okay. So
and how many units was it?
In 2019, we bought it for $3 million. We had to raise 1 million plus at that time. So as a GPs, 3 of us put 100K each, and then the remaining money Since myself and my other friend, we said we will raise the funds, though we started working on it. What we did is we reached out to our close friends who kind of does these kind of businesses and all. And I called like 20 plus people, and then around 20 people. And I thought that maybe 5-10 will come and join me. To my surprise, all 20 said yes.
Oh, wow. That's
I was
that does
shocked.
not happen. That's not
Yeah.
normal, but that's great. You must have had a beautiful story for this
Yeah.
thing and some great projected returns. So
Yeah.
looking at that, so you're buying it for 3 million. How many units was this one?
96 units.
96 units for 3 million. And what was your projection on so buying the 96 units? So we're paying, holy moly, 31,000 a unit. Goodness gracious, that's inexpensive. You won't see that right now. That's awesome. So 31,000 a unit. And how many of you said 40 of the units were down completely back to the studs, right?
Yep.
Okay, so you had 40, and were the other 56 still being occupied, or
Yes.
they were still right? Okay,
50 plus were occupied, and then we started working on these, and we did some mistakes while doing these baby steps, like contractors. We thought that there would be plenty of contractors in that town, but we turned out it's a mid-sized town, like 100,000 population.
Okay.
So we couldn't find enough contractors, so we had to take contractors from Dallas. It's a couple of hours from Dallas, so that was one lesson learned. And obviously, and the project got delayed a little bit because of this remote workers. So whenever we had to do things, then we had to coordinate the timing so that we, for example, flooring, right? Flooring guys, we say that, oh, we need to flooring on this one. Then they will say, oh, we are busy. Let's take in 2 weeks, type of thing like that. That scheduling was a big challenge. So eventually, even though it is managed through the property management company, third-party professional property management company, still they had to go through that delays. So a project got delayed a little bit, and also we had a few surprises in the process that we had to go through, because each town has a different inspection style. So when we took the contractors from Dallas, they thought that the inspection would happen certain way, and then the city where we are, they wanted to see certain way. For example, the electrical inspection, these guys opened the boxes and showed everything, and certain areas they put the sheetrock, and then they didn't like that one. They said that the entire area should be out of sheetrock, so we had to pull out the sheetrock again and put it back after the inspection. These kind of small mistakes we learned in that process.
Yeah. So, with anything like this, it's important to, just listening to you go through it. It's so important. So me, I'm a commercial general contractor and been a contractor, since 2007. So yeah, every area is different for inspection. So it's important to note that. Two, whenever you're in a new project, not a bad idea to contact the inspection department, kind of find out what they're, how they're doing their inspections, where they set their inspections that are going to be needed for your project. And it's difficult on some of these because you're just typically doing a minor refresh, so there might not be any inspections. But when you're down to the studs, it's very important before you cover anything up that everything is inspected, right? Or you'll be ripping it out. So that could become a horror story. Luckily, it sounds like you guys got such a good deal. You were able to work your way through it on this one. So, all right. So you learned a lot of lessons. So the other thing that you'll get with something like this, I assume, and you guys might be able to speak to it, is you get more due diligence, things that you weren't even looking for that popped up and hit you and made you spend extra money. Then you start building that list of, oh, well, I'm not going to let that happen again. Right. Yeah. So what were some of the things that caught you off guard?
That inspection style, that is definitely one big surprise, because we had to redo some stuff. And the second thing is material supply. Let's say we were installing a local HVACs, right? So that market doesn't have enough equipment there. So you need to plan those things from the sizable market. So that is another thing we need to see. If we don't find HVACs and all locally, then accordingly need to source it.
And when you're doing that large of a project in an area where there just, there's not a lot of large projects going, you have to understand you have to get the products ordered way in advance. Then if they come in, the warehouses, they don't want to hold the products for so long. So then you have to figure out, where am I going to store these products? So then they're being moved, and maybe you store them in a storage unit. Then you have to account for the cost of putting them in a storage unit. Who's going to move them around? Are they going to get damaged from having to be shipped here, there, and everywhere? So there's a bunch of things to take into consideration: coordination, timing. All these things are so critically important when you're doing that, or you run into what you were saying, then you run into delay after delay, because you'll have, let's say, the flooring contractor going in, you might not have the correct amount of flooring on site. So he finishes, he leaves, he's then off to the next job, and he's not coming back till he finishes the other jobs. So if you didn't have the right amount of material, maybe not all the material, then the job's not going to get done, and you're going to be delayed and waiting. So there's so many things to take in. So on that project, you were relying on the property manager to do all of the work. Is that how I understood it?
Yeah, property management company has a project execution arm, but that project manager was not good. So that's what we learned. We should have hired a third-party property manager to run the show better, because this property managers, project manager is shared among multiple projects, right? So so for him, this is one of the projects. So rather than the project, for us, it is the project at the time. So,
right. Well, so, good things to this. One, you guys definitely got a great learning experience. So the key is always buying right. So you guys bought this thing right, which allows you, when you're buying something right like this, it allows you these couple missteps in order to still be able to get through this deal, make things right, learn a bunch of things that you're then going to do better on the next one. And as you guys started to scale and get larger, based on your total unit count that you've built up, you obviously have perfected all of these things and have been successful in doing so. And so, I mean, this has been great going through this and understanding it a little more in depth for anybody that's trying to do your first project. You have to go ahead and find a project, do it. The numbers have to obviously work. And just be prepared. Have a large contingency in that number, because on your first deal, you are going to miss stuff. Yeah, your first, second deal, you're going to miss stuff till you start to learn. So, all right. So let's go a little deeper. So this one, when you got through it, could you kind of look at the numbers? So you got through it, and were you able to get it predominantly all leased up, or how did that all go through?
This one went through fine, and then we got confidence, and then it took extra 4 or 5 months to finish, but we were able to rent those units quickly, so that in the meantime itself, like once the things were going smoothly, right, and we started thinking about the second project and third project like that quickly. So the fundraising, we felt that it's real challenging, but luckily we were able to pull it off quickly. Then we went for even bigger units next time, like 200 unit project. And we decided, so we should go bigger to get more economies of scale. So the second one was a 200 unit, third one was a 200 units, fourth one we went for 400 units.
Wow. Yep. That's perfect. It's a perfect. And so I think that, a couple of things, when you're starting out, 100 units seems maybe large to somebody starting out, but really when you get in something smaller than that, it's hard to even pull a property management company in, right? And so when you're bringing in multiple partners like you did, it allows you to start at this medium size and then work your way up, but you're able to put professionals in place, underwrite this thing where you can put the money and allocate the money. I'm interested to find out, did you, as you were growing and getting more and more properties, did you stay in the same general vicinity, or have you guys expanded to multiple states? How has that looked as you were growing?
After that first property, then we came to Dallas proper. So we started buying in Dallas area rather than suburb, because of that execution experience we had. We thought
Sure.
it's better to be very close to place where we live and then start executing. Once we are comfortable and learn enough, then we can start executing more remotely. So next 4 or 5 projects we did locally, and then we started expanding to other cities and other states.
So when you've expanded, have you just expanded to certain areas and then bought multiple properties in those areas, or have you just gone in a large vicinity and just bought by deal only and it doesn't matter about the area?
So most of the times we stayed within Texas. So in Texas Triangle, like Dallas, Austin, and Houston, to be precise. So we picked the properties in those 3 cities. And one we expanded to Tennessee just to test it out and see whether we can expand to Tennessee. Because eventually we wanted to be in all Sunbelt states.
I see.
Too, from Texas underwriting point of view. So that's why we went to Tennessee. So
yeah, I think of something that I feel, and I guess I would like your opinion on it. So I am a believer in, like, where I'm in Eastern North Carolina. So I like to look right now. The only places I'm looking are North and South Carolina, the eastern portions of North and South Carolina, because I feel like I'm most comfortable with those markets, the market environment, and it's easy for me to understand and relate to those areas. So they're so close to me. If I need to shoot down there, it's easy to get to. Tennessee is a great market, right? So depending on where you are in Tennessee, but that's a fantastic market. So and then if you expand out, I think that you focus on 1 or 2 areas where you have some type of connection with those areas and maybe look at those, not doing it with a broad brush and looking everywhere. Focus on these specific markets, building relationships in those markets, and then you continue to grow and thrive in those markets. So that's awesome. Now, you have since moved. Sounds like you've done well. Have you had any of these projects that went out of whack and didn't do well, or have you actually feel like you've been performing well on all of them?
Nothing was out of whack, but we did one mistake, not mistake basically, but we were buying this at that time, like 1.5 year back. Everybody was going with variable interest rate loans. That was the predominant loan available at that time. So we bought one property like that, a couple of properties like that. So one of the properties we bought was the variable interest rate loan. So that kind of gave us additional stress for us. So it's mostly due to the interest rate. It chewed up all the income, and then we had to suspend distributions to investors. And we even had to do some funding from general point of view. We did not do any capital calls or anything like that. Still, we are managing through. Yeah.
That's great. So, the majority and the tough thing about multifamilies, there's a lot of them. A ton of multifamily was done on bridge debt, right? And so over the past couple of years, and that's why they're seeing so much stress in that. And to hear you only say that you haven't had to do any capital calls, I mean, that's kind of based on you have 3,600 now, or 3,800 doors. Now you have 2,700 doors. So you've cycled through a little over 1,000 of them. And not doing that, that's amazing. So that's a great testament to you guys doing great underwriting initially to buying and not over jumping in. I think a lot of people, got sucked into the market where I would hear people saying that they're buying this and, oh, we did so great. We were the highest bidder and we're able to get the property and we locked it up. And I'm like, that doesn't sound, I don't know, that sounds like something I'd be bragging about. That just might mean like you are a little too, into the property and overpaying. So, this sounds like you guys have stayed true to your underwriting guidelines throughout this crazy market that we found ourselves in. And what you said at the very beginning is you pivoted into development, which me as a builder love to hear about and would love to dive into that. So could you walk me through how many projects are you in development on and what do those look like?
So right now I'm into 4 development projects. So the reason being the competition is high, as you mentioned, right? People were bragging about paying highest price and taking the projects. I felt uncomfortable to pay a lot and then getting into trouble. So unless I see the real value in the pricing and then opportunity to get the returns. So I thought I should get into development, because if I want to buy a good property, Class A, at that time they were asking $300,000 a door. Then I thought definitely it is not going to cost $300,000, because for 350,000, the single family houses are being built. So apartment should be much less than that. That
Right.
was my starting thought process. And then I started doing some more research, and eventually I found out that the construction cost is very low. So it's almost like 50% of that. So I thought, okay, let me start looking into this construction project. So I got the opportunity to co-syndicate the first construction project at 306 units. It's still going on, like 2.5 years back we started. So it's still going on. And then after that, another 330 units. We took the raw land and went through the entitlement process, and we bought 20 acres in Austin to do a mixed development hotel, retail space and townhomes. And also I did a land development for single families. So these are the 4 construction projects I'm associated with at the moment. And then I sponsored, rather, not associated, I'm sponsored. And still looking for more deals in the construction space. So
Wow. Okay, that's awesome. I'd love to dive into those a little bit. So first one, if we can, let's dive in to the 360 and the 330 units. So on both of those, we can pick one of them. So just pick one or the other, and let's say, how many acres did you purchase for that of raw land? And could you give us some insight on how much did you pay for the land, and kind of walk us through how you went through it? Were those two fully entitled when you purchased them, or did you entitle them?
No, the first one is an entitled project, because we don't know much, so we wanted to be a little safer. So we bought the entitled project. So it's a 15 plus acres project, like little over 15 acres. It's on a major road in the town, next to Walmart. We felt that it's very strong because the location would really get good traction, right?
Mm-hmm.
So that's why we went for that 306 units. And then we hired the general contractor and started working on it. And then in any time first project, right, it's always have some hiccups. So we went through some hiccups, and we pretty much resolved all the hiccups, and now it's back on track. So that is.
So let's dig in on that. So a lot of time, I mean, majorly me being a GC, so the biggest unknowns in any development project is the quality of the dirt. The flat work is where you're going to run into all of your unforeseens that are going to trip up a GC, trip up you, and can cost a lot of money. So it could be non-compactable fill dirt, tanks underground, unsuitable soil, wetlands. There's a ton of different things that can pop up that you might not have seen. So what were some of the things that caught you guys off guard on that first development project?
So the got the geotech report, so we were confident that it's not going to bring a major surprise from the that point of view. And also we checked on that oil tank kind of thing, and preliminary whatever we could do. So that is another thing we did. But the amount of dirt, it surprised us. Like basically when we dug up, and we felt that there was more that came out than what we originally thought. So
if you have a large buildup of root mat, then they have to pull out. So when they clear the land, you might clear the land, and if that has a root mat buildup that's not compactable, you have to pull out that root mat. Sometimes that's a foot, 2 feet, 3 feet.
Mm-hmm.
And if you're having 15 acres and you have to pull out 2 feet or 24 inches of dirt on the site of root mat to put in compactable fill, that turns into $100,000-$200,000 real fast to just put dirt on your site, right?
Yeah.
So how much dirt did you have to bring in?
I don't remember the exact quantity, but it was not too high, but it's a little more than normal. Yeah, that's what it. So that.
All right, so that wasn't bad then. So you guys got your dirt in, so you went a little over on your dirt. So it's important, to have some extra dirt in your contingency, right? So you figure that on the next one. So you guys got that one, and that one was fully entitled. So that's really the only major hiccup that you found.
Yeah,
on that?
in that one, and then the construction went through, and then again, materials was a challenge because we started this one during COVID. The prices have gone up. The lumber prices went to like a 1,500 or something like that. So luckily we locked at 700 or 600 something of that number. So we were fine. It's little. It was at the normal price itself. We locked it. That much I can say.
So did you guys have? Did you guys have? I know the biggest challenge if you were starting back then, and so when we were building it, it was all of a sudden you couldn't get anything, and so then you can't get your, electrical panels. You can't get, your meter sets for electric. You can't get HVAC units all of a sudden. You couldn't, everything, it be bottlenecked for a good year and a half right around then. And everything, you could not get it. And it was just, every job was just on pause or taking 5 times longer than it should because you can't get anything. And then it's, what can you adjust to get to it back to an engineer to let them allow you to adjust to move? So it sounds like you were running into that nonstop.
Yeah, I mean, a little bit of hiccup at wood and all that. So we were able to manage it. Luckily, we locked the rate before it started going up. So the project was kind of delayed by a couple of weeks because of the weather. It was raining like hell. So that is another thing.
Right.
We learned, like, when you start the project, better you plan it. Like horizontal development should have a clean 3 to 5 month span so that it will not face any hiccups. Otherwise, you need to wait for the weather every now and then for each slab, right?
Well, that sounds awesome. So that one is moving and been going good. So then I'm interested to find out. So, based on our discussion, you've done a ton of multifamily. Now you said you have 20 acres in Austin that you're doing mixed use, right?
Yeah.
So you've got hotel on there. Did you say you're doing some retail?
Yes, we're doing retail and we are doing townhomes.
Well, that's awesome. So tell me a bit about that one. Did you take it through entitlement?
Right now we are going through the entitlement process. We bought the land and then we are going through the entitlement process. It should be done in next couple of months. After that, we will start working on actual construction phase.
I'd love to share with people kind of how that looked for you going through that entitlement process. And so when you got this 20 acres, could you give us how much did you put into the 20 acres, or how did you set up the agreement to purchase that?
So there were 4 different parcels. So all those 4 parcels owned by like 3 different parties. So we had to.
So 4 different parcels owned by 3 different people,
like 4
3 different parties.
Registrations. Yeah. 3 different parties. So we 3 different clauses are at 4 different clauses. I mean, 2 are combined. So it's like 3 different clauses, we can say. So with the fundraise was different. We need to get different loan because each one is a different parcel, right? So we could not go and then get a lump sum loan for all parcels at once. So we went for bank loans with 2 different banks. So we got around 70% of the price as a loan. So 30%.
So you guys went and purchased. This is great. So did you find all these off market, like straight direct to seller? Okay.
Yes.
So you found 4 parcels owned by 3 different people, direct to seller. And what attracted you to this area? What was around it?
So it's on one of the major freeway. And the reason we went is like the seller himself initially wanted to partner with us, and later on he changed his mind and he asked us to buy it. So
the one that owned one of the three people initially that you were talking to,
who has like 2 lots. They said that we want to partner with you, and then we will have the land. So let us buy the remaining 2 parcels and go into the project and develop it. That was the original thing. And later on, they found another project for themselves to build on. Like they do single family homes. So they said, we want to go to our project and then we want to sell this one and don't want to be part of it anymore. So that is a surprise. Then we had to go and then change our plans and buy 4 parcels instead of 2 parcels. as well
So
as
with the other two parcels, did that owner introduce you, or did you just do a cold reach out to them? How did you connect with the other two owners?
yeah, owner introduced, yeah. It's all the
owner
neighboring
introduced.
parcels, yes. Yeah.
Okay. So that's awesome. So and so when you were looking at these, and it sounds like you closed on these. So a lot of times when you're doing these development loans, you want to write the contract, and depending on the size and the dollar amount, you don't proceed and close on these until you get full entitlement. Is a lot of times how developers write it up. Sounds like you guys have just gone through and you were so confident in the property, you went ahead and just closed on the 3 lots and owned them. Once you owned them, then you started working on entitlement. Is that how you did it?
Yes. We started the entitlement process, but in the meantime, this structural change happened. Like they wanted to not participate in the second phase of construction and all. They want then we accommodated that change. Like they asked us to buy it because they got offers from outsiders to buy the land. So we thought that we already started the entitlement. We have to hold it, but they're not willing to hold it for a year on the contract. Usually the lands are like 6 months to a year on contract you can keep, right? But it's not.
So how long did you have it under contract?
I think a couple of parcels, it still took like 4 or 5 months to close it. And because of the loan processes, the banks were taking enormous amount of time to underwrite and approve the loan. So it was the bank that delayed. So they were not happy, but they had to accommodate because we were transparent all along. Like we applied for this bank and they are scrutinizing and all that. So eventually we were able to close it. Good part is the reason we were so confident is like there was other projects that are sold. The entitlement project that was sold per acre was almost double the price what we paid for.
That's always key. So you seem to be very good at finding and locating great deals, which is what makes everything successful, especially in development. If you don't buy something right in development, you might as well not even buy it. So that's correct. So it sounds like you guys got a great deal, and then that gives you the confidence to move and take that calculated risk. Say, hey, I'm going to close on this before it's fully entitled. So now you go through this entitlement process. You can exit yourself if you wanted to not take it through. You can go through that entitlement process once you do, and you guys could make a payday on that and just sell the entitled land like you did for your first project. Or you go ahead and take it through development and you're double dipping. So you take it through the entitlement process, taken and combined those 4 parcels into one master development plan. Then you can sell that off entitled, which is what they would have one quick exit plan if they decided to pursue something else came along, or they didn't feel as good about it all of a sudden, whatever. Then they can exit at that point, or they can take it all the way through once they've got that entitlement through development and make a double up their money again. So this is a fantastic way that you guys are seeming to get through to make some big money. So when you got that low cost basis, what did that look like? Can you give us like a high level underwriting on how you're looking at this and what your upside is?
So we pretty much bought the land for, I would say, 20 acres, right? 13 to $14 million. Okay. And then we got a 70% loan on average because the different loans. So then obviously the lender has forced us to escrow the interest for 2 years. So we had escrow the interest money so that we will not worry about monthly payments. So we started this entitlement process. Originally, we thought of putting multifamily, but there was another entity that is building 1,200 apartments. So we don't want to compete with the 1,200 apartments. So we changed the whole plan to townhomes and then retail and this one.
So do you have an idea how many townhomes? What's the footage of retail and the footage of
townhomes wise, we are building 100 townhomes. So because there's high demand for homes in that area. Homes go for almost 900 to 1.2 million. in that
Not
area.
for single family homes?
Single family homes. So
Okay.
townhomes we can easily sell around 500K range.
500 to 600 probably.
Yeah. So I mean, we are estimating it to be much lower in our underwriting. So so that we want to be very conservative. So around 100 townhomes and around 50 plus thousand square foot of retail. Okay. And then 132 key hotels. So we got approval for the hotel. We are building Staybridge Suites. So
okay. So we got 50,000 square foot of retail, 132 key hotel, and 100 townhomes.
yeah.
So that's definitely a good size project. So, you know, with a 50,000 square foot retail strip center, you can get in a nice anchored, you know, tenant. So you could get a national tenant to anchor that retail center and then fill in with smaller tenants, which is great. 100 townhomes and 132 key hotel. So, you know, that sounds fantastic. So one of the things that I always look at in this type of an environment is, you know, do you have quick accessibility, in and out accessibility? So is this anywhere near a signalized intersection? Do you have a left turn ability to get in and off the site?
So this property is located on access road to a major freeway.
Okay.
Okay. So another road is coming from inside, like basically from that access road. It's a corner of that access road and the road that goes inside. So we have access from not from the access road, from the other road. So it's just like they don't want us to open up on the access road because there is not enough space for deceleration. So they look for the deceleration space, right? So because they approved another before we bought the land, the next door neighbor who has like a storage space, right? They had that exit from the access road, so they wanted to give some space. I think that's the reason we did not get from the main access road, but from the side we got it. So still it is okay for us. So just ours is the corner bit. So
so anybody listening that doesn't understand, so just so we can clear that up. So what he's saying is from the access road, they would need a decel lane. So in the Department of Transportation wants them to add a decel lane in order to get the access to tie into the road. And a decel lane, those are extremely expensive because you have to build them up to the DOT standards. So, you know, those can be 250, 300,000 just to do those deceleration lanes to tie into the road, which can get extremely costly and impact the project as a whole. So you're good. So you're getting the tie-in on another road. So the main thing that's good about this is you don't need quick accessibility for hotels. If it's a designated retail shopping center, so what is your thought on the retail? What type of a tenant mix are you guys going for? Have you thought that far down along the lines on it?
Hotels, restaurants, and then small businesses, because there is like a big apartment complex coming next door, right? There will be saloons. They may need space, and they need a quick eatery, and they need a small grocery store type of thing, right? And they need
absolutely. So this would be what's called a neighborhood shopping center for anybody. So this would be great. So all of your quick grab items and local items. So, you know, salons, small pizza joints, you know, small little neighborhood restaurants, stuff like that, that you get long sticky tenants and, you know, that's not really competing with this large e-commerce craze that's going around. So not big, huge retail shopping centers that have the large places where you're having everybody order everything online. A lot of these things you can't order online when you're going to get your nails done, hair salon. Those type of tenants are a great mix for something like this.
Yep, that's what we are focusing on. So
awesome. Well, that sounds fantastic. So what is the so then when you're underwriting this, you know, when you're looking at townhomes, you got 132 keys and the 50,000 square foot of retail. So when you're underwriting that, what are you guys looking for this to pencil at when you're all done? What is the quick underwriting that you're trying to have it value out at?
So the project is coming around 80 to 100 million range, depending on the level we want to get in and different aspects, right? I mean, why I gave $20 million range is so we have the thought process, and retail, we may go for the two levels.
Oh, okay.
And the second level, we want to see is small offices like insurance offices, type of facilities we want to build. So if we decide to that, and if the township agree, then it will touch 100 million. Otherwise, we'll be around 80 million range.
Oh, that's amazing. So that's awesome. You know, we circled around from you starting out looking at single family homes to now doing 80 to 100 million. So, and it didn't take too long. It doesn't sound like. So, man, I really appreciate you letting us in on, you know, what you've been doing, Sridhar. And man, it sounds amazing. I'm interested to see where you go in the months and years ahead. It sounds like you guys have a lot of upside potential on what you guys are moving towards.
Yeah, thank you. So now I'm launching, I'm one of the fund managers of a large fund we are building, like a $500 million fund to acquire all these trust properties and then other properties. So that is my next year and following year's target.
So now if someone wants to get in touch with you to find out more about this fund, this $500 million fund that you're putting together, what's the best way to reach out to you?
So they can reach out to me, Sridhar at infinitycapital.ai.
And we'll put this in the show notes so you guys can reach out to him. And I'm so thankful that I got you on the show today and where it's able to hear about you. It's so impressive with everything that you've put together in this short amount of time. And I appreciate you taking the time to explain to everybody here.
No, thank you. Thanks for giving me the opportunity. It's
awesome.
Really
hopefully we can get you on again soon once you're doing some more stuff and find out more about it. It sounds like you have.
Sure. I mean, next year I'm targeting 10 projects. So hopefully.
That's exciting. Well, if there's anything near this side, my goodness, you're going to be the next Grant Cardone coming through here. All over the place. Well, that's awesome. Hey, thanks again for joining us. And you guys, thanks for listening in. We'll see you next time.
See you. Thanks.